Hey, it's Paul with your June market update. Let's talk about what's really happening in the market right now without any drama and no doom scrolling. Here's the big picture. In May, Maricopa County recorded just over 7,000 closed transactions. Now that's down about 10% from last year, down about 6% from April. New home closings held relatively steady, but resale activity slowed more sharply, down about 11% year over year. And part of that drop is seasonal, with May 2025 had two fewer working days than May 2024, but it does reflect the hesitation in the resale market. Now, here's where it gets interesting. Despite the lower volume, prices moved up. The overall median price for May did hit $485,000, up 5.2% from April. And even resale homes saw a nearly 4% jump over month. But what was the big driver in that median number? It was a surge in luxury sales, supported in part by gains in the stock and crypto markets. But that rise isn't evenly spread. It's more of a pricing illusion than a full market rally. Most market segments are not gaining ground. In fact, price reductions and concessions remain widespread. Over 50% of transactions in May included concessions that averaged over $11,000 on a home price of $460,000 home. So what's causing this mixed market? Let's start with mortgage rates. They have bounced between 6.87% and 7% in recent weeks. After dipping slightly, they climbed again following a stronger than expected jobs report, and we're stuck in a bit of a holding pattern as the market waits for more clarity on inflation, Fed moves, global trade policy. And speaking of trade, tariff tensions are making headlines again, if they ever went away, and adding volatility to both consumer confidence and supply chain expectations. While mortgage rates haven't skyrocketed, they also haven't dropped into the dream zone of the fives, and there's little on the horizon that suggests they will anytime soon. So builders, they're adapting. Many are buying down interest rates into the fives to keep new home sales moving, which really explains why they've held up better than resales and why we see struggling markets like Queen Creek, Santan Valley, where all of those are. New homes have made up 21% of May closings all across the valley, slightly higher than this time last year. On a local level, inventory is up but stabilizing. We're hovering around 29,000 active listings, which would be healthy if demand were stronger. The Cromford Market Index that we watch has dropped again to 73, pushing deeper into buyers' market territories. Cities like Scottsdale, Phoenix, Chandler, Gilbert, they've all cooled the most for our sellers. Well, we see Fountain Hills and even Maricopa showing mild improvement. We now have 3 cities in the seller's market. We have 8 in a balanced territory and 6 in a buyer's market. Translation, the market is cooling, but it's not collapsing. And despite the fear-based headlines, we're nowhere near 2008 levels. Inventory levels today are less than half of what we saw in the lead up to the crash. Plus, homeowner equity, wage growth, and economic fundamentals look a whole lot different now. So what does this mean for you? If you're a buyer, this might be your window. There's more choice, negotiable pricing, and sellers are willing to deal, especially if you are well qualified. If you're a seller, you can still win, but strategy matters more than ever. Pricing, presentation, and timing are key, and what worked even 6 months ago, it might not work today. So as always, if you want straight answers, real data, and a strategy tailored to you, let's connect.